Okay, thank you. We'll kick off now. So welcome to BDO's Financial Reporting Update webinar. I'm Moses Surfety, and I'm joined today by Anthony Appleton, who's a partner in BDO's Technical Financial Reporting team. A bit of admin before we kick off. We expect the webinar to last about 45 minutes. There'll be time for Q&A after that. If you do have any questions, please use the Q&A function, which you can access from the icons at the bottom of your screen. Time permitting, we'll try and answer the questions during or at the end of the webinar. And if we can't do that, then we'll try and get back to you after the webinar. But if you post the question anonymously, then we won't be able to get back to you. So if you do want a response, don't ask anonymously. A recording of the webinar will be available and emailed to all those who've signed up, together with the slides. So if you aren't able to listen to the whole webinar, then there'll be opportunities to do so afterwards. Moving on to the agenda, so what do we have today? Firstly, we'll begin with an overview of the narrative and financial reporting considerations for the conflict in Ukraine. Secondly, we'll be looking at some recent IFRS and UK GAAP developments, including a special focus session on IFRS 17, which is the new insurance standard, but which can also be relevant to non-insurance entities, and that's what we'll be focusing on. So, we won't be focusing on insurance entities. Thirdly, we'll be looking at sustainability and climate reporting news, as a lot has been happening recently in this area in recent months, including further steps in the implementation of TCFD reporting in the UK and the publication of the first exposure drafts for sustainability disclosure standards by the ISSB, which is the new global standard setter and part of the ISSB. So moving on to the Ukraine conflict, we expect that many businesses will be affected by the conflict. That effect may be on a micro level or on a macro level. There's also the Belarus, so we'll provide an overview of financial reporting considerations arising from those. So firstly, I suppose if you're a December or January reporter, then the first thing to consider is the timeline of events and how those may affect you. As you can see on the left-hand side of the screen there, we've got that for December and January quarters. This would mainly be a post-balance sheets event, which means therefore that the effect on your financial statements is going to be mainly around narrative and around disclosures, and perhaps also factoring into the going concern a February reporter or March reporter, then potentially you will have to give additional disclosures as well as consider the effects on your accounting. Why? Because the conflict effectively started on 24th of February. That's when the first missile strikes came out. So you know, and any reporter with a date subsequent to that would have to factor in or have to consider whether there's anything that affecting the accounting. As a reminder, and this is a bit of an aside in terms of dividends, you know, directors will need to consider the effects of a conflict when determining their dividend policy. So even if you've got a December year end and your accounts look fine, you still have to factor in the effects that the conflict may have on your liquidity or solvency and on your consumption of distributable profits up until the date that you approve a dividend. So it is something to make sure that your distributable profits have not been eroded by events. So that's just a reminder on dividends. So moving on now to the post-balance sheet event disclosures. Again, like I said, this is mainly for December or well, I suppose even earlier, and January reporters. A question that's often raised is, well, how much detail is required for a post-balance sheet event note? And we've set that out here on the left-hand side of the slide. The nature of the event and an estimate of its financial effect, or statement that such an estimate cannot be made. Now, in terms of what events, or what could those events be? Again, some ideas here on the right-hand side. Destruction or seizure of or abandonment of tangible and intangible property. So if that's happened after the year end, let's say you have operations, say in the Ukraine, that have been significantly disrupted, then or that have even bombed, or then that would require disclosure. If sanctions have affected either the entity or the customers, suppliers, or lenders, that's something that could also warrant disclosure. Thinking about lenders specifically, there, if you're borrowing from a Russian bank and sanctions mean that you're not allowed to repay them, well, does that then trigger breaches? There may be quite a few considerations there. Equally, a reduction in revenue, either caused by supply issues or by having direct relationships with customers in affected areas. That would also be a disclosable event. There may be issues with liquidity, as I mentioned earlier, or in terms of, if you're counting on receiving some funding from an investor who has been affected by, or a lender who has been affected by the crisis, then that may require disclosure. And equally, commodity prices, share prices, and foreign exchange volatility, all of these can affect areas on the balance sheet that, whilst you wouldn't account for them because of the conflict happening after the balance sheet date, an investor might want to know about it. And I suppose in terms of post-balance sheet events, it's about thinking about the user's needs or information needs, and weighing up whether it's material enough to warrant disclosure and in the financial statements. So moving on to risks arising, and again, this is probably just some thoughts that we collated. That there will be other risks, presumably, but those obvious ones there. We've got here viability of operations in the region, or operations that depend on the region. Impact on supply chains. We're hearing about perhaps wheat shortages, or worst case scenario of famines, at least maybe localized. Credit risk for affected customers. Either your customers may not be able to pay because they're dependent on receiving funds from other entities that are affected. So there can be knock-on effects, which you might not think are, you might not obviously think of initially. Clearly, there's the risk of the conflict spreading. Again, you might think about that in terms of other countries in the vicinity. And like I said, we've got these other ones here on the bottom half of the screen as well. Particularly cyber attacks. Those risks seem to be going up, or at least there seem to be more cyber attacks since the conflict started. So what preparers will need to be doing is having to think, well, are there new risks emerging that perhaps I wouldn't have normally factored into my normal reporting? Boards will need to weigh these up and then decide, well, these could affect us. They might not be affecting us right now, but is that something that a user of the accounts would be interested in knowing, that we've got some exposure? Again, sometimes it's quite hard to quantify these exposures, but at least if you're telling the users of your accounts that there may be an issue, at least you're giving them some useful information. So, in terms of the actual narrative reporting areas that you might need to revisit, and I suppose that when we wrote this slide, was mainly thinking about the entities that are affected by, for whom this is a post-balance sheet event, but equally this will apply to ones for whom it is an in-year event, and market trends and factors, supply and demand, is that changing? How is the conflict going to affect your strategy and business model? Is there a change? Now again, if it's a post-balance sheet event, you probably wouldn't go into too much detail on it, but you might want to give an indication that you're reassessing it. Whereas if it's an in-year event where you've had to change your strategy and business model, then you might go into a bit more detail on that. Principal and emerging risks, again, most entities need to report their principal risk if you're required to do a strategic report under the Companies Act, and that might be almost a good place to start, because there at least you start talking about your risks. Now, some risks, the conflict may affect some or all of your risk. It's pervasive, or it could just be localized. And in terms of how you draft that disclosure, well, it's about having a think first of, well, is the conflict affecting more than one of my risks, or is it just a risk on its own that I would talk about? Again, this corporate governance section 172 statements. Again, if you're making decisions here and now about your operations because of the conflict, you might want to talk about it there. And again, on the effect of stakeholder relationships. We've got there on the left-hand side, going concern and viability. Again, that's going concern is something that an assessment that needs to be done at the reporting date. And I suppose there needs to be an acknowledgement that this is an evolving situation, and that as a preparer, it might be difficult for you to come to a view on this. And that's when disclosures about judgments and estimates that are being made in the going concern analysis and the viability analysis probably need to be enhanced or beefed up if your business is being affected by the conflict. Just as a reminder as well, if you end up concluding that there isn't a material uncertainty ongoing concern, but that requires significant judgment, it's best practice and it's recommended that it's actually a requirement that you disclose that in the financial statements. So now moving on to thinking a bit about actual accounting rather than narrative reporting. We've mentioned judgments and estimates already. Again, that's something that you might put into the front half on your going concern piece, but you would probably also put it in the actual the body of the financial statements. Risks arising from financial instruments. Again, that's something that's normally covered both in the director's report and in the back end of the accounts. They may need to be enhanced. If credit risk is going through the roof, even though maybe at the year end it wasn't, then you would probably want to be talking about it in your financial instruments note. Then we've got impairments. Those again, and those might be slightly different for somebody for whom it is an in-year event as opposed to a post-balance sheet event, but in terms of the information that you would use. But excuse me, similar to the advice that came out at the beginning of the COVID crisis, it may be more appropriate to prepare several cash flow forecasts and then give them a probability weighting rather than just trying to capture it all into a single impairment model or cash flow forecast model. Again, you might want to be giving more disclosures about that as well in the impairment note. Fair value measurements and disclosures. Again, you've got increased uncertainty. So where you've got financial instruments or other assets that are carried at fair value that you have had to incorporate uncertainty into the measurement. Again, that would be probably a change to your normal disclosures. You may also find that, especially if you've got operations in either Russia or Belarus or even in the Ukraine, that your ability to, so whilst you might control these assets, your ability to access the benefits embodied in those assets isn't what it was before. So we're talking there about IFRS 12 disclosures. IFRS 12 is a standard on disclosures, or interests in subsidiaries and joint ventures, etc. And IFRS 5, again, we're hearing of companies divesting from themselves from their interests in Russia and Belarus. That gives you an accounting issue in terms of classification if you meet the criteria for being classified as held for sale, but also measurements, because you're talking perhaps of trying to make a fair value less cost to sell assessment, and that might not be that easy in the world that we live in. Again, we talked there, we've got the inventories, deferred tax assets, pensions, valuations. Again, those are areas that are likely to need to be revisited. Revenue recognition as well. Your contracts may be delayed, or there may be more uncertainty surrounding that. So again, something to think about as well. And then, insurance policies, again, this was something that came to the fore as well during COVID. Are you covered for business interruption, or are the exclusions such that you won't be covered? Again, there will be judgments that need to be made, and accounting judgments that may need to be made in terms of either recognition or not recognizing receivables from insurance policies. So in terms of further guidance, the ICW have got a resource hub which has got quite useful information. The economist intelligence units, again, might be helpful to look at their analysis when you're looking at more macro effects. And the CCAB put out a statement for members, and that will include members in the professional and in practice, about ethical considerations, sanctions and notification obligations, and about keeping up to speed with developments. I think what they're saying is that saying that you weren't aware of something is not going to be a defense. So if you're an accounting professional, it's definitely worthwhile keeping up to speed on this. And then you've got UK government guidance and the FCA guidance. We are expecting to be putting out a publication on the financial reporting considerations for the Ukraine crisis. If this comes out before we email the slides and the recording, we'll attach it to that, or put a link to it. Otherwise, keep an eye out on our website at bdo.co.uk. I'm moving on to financial reporting updates, and again, there's not much happening, so I think we'll all be we're thankful for that. But just wanted to draw your attention to an IFRS Interpretations Committee agenda decision, which was discussed at their March meeting, and we're expecting the ISSB to finalize it. It was a rather narrow question, but actually probably quite topical in terms of the Ukraine conflict as well, in terms of it was dealing with the question as to whether a demand deposit held with a bank, by an entity with a bank, where the terms and conditions did not prevent the entity from accessing the amounts, but there was a contractual obligation with a third party to not effectively touch those amounts, as to whether those amounts would be classified as cash and cash equivalents in the statement of cash flows and the statement of financial position. And it's worth pointing out that if the entity did use the cash in the account, there would be a breach of contract. So what was the answer? The the committee decided that it should be included in cash and cash equivalents on the balance sheet because the restrictions do not affect whether the amounts held in the bank account were considered cash. And they added this thing at the end. You can see on the bottom left of the slide that unless the restrictions change the nature of the deposit, it is cash until that, until the restrictions change the nature. For the balance sheet, the answer was the same. There was an acknowledgement that you may want to disaggregate the cash and cash equivalents line when relevant to understanding of the financial position. You might think, well, if it's a significant amount of cash, then it would be useful for the user to know that these aren't available, but they're still cash. In terms of disclosures, again, break down the components of cash and cash equivalents, disclose the amount of cash not available for use by the group, which again is an existing disclosure requirement, and also perhaps factor it into your liquidity risk analysis, because if this cash isn't available, then you don't want to be painting a misleading picture. Now, in terms of what else this may affect, and the ISSB identified some areas in its its outreach where there may be minimum cash balances to satisfy warranty claims, or minimum cash balances arising from loan covenants, or minimum reserves that you may need to hold with central bank. So again, it's just probably worth, if you do have some bank accounts where there are some restrictions, it is probably worth you familiarizing yourself with this agenda decision. So moving on to UK GAAP news. Excuse me. There's now a January 22 edition of IFRS 102 or IFRS 100 to 105, and basically this just incorporates all amendments and made since 2018, when the last major that was the last major issue of the standards, as well as changes in Irish company law. The second piece on this slide is about LLP swaps. Again, rather narrow. It only affects LLPs, which is new, isn't expected to change much practice, but the one area that where inconsistencies were identified and the swap has been changed is when it comes to whether division of profits is automatic or discretionary, and there's additional guidance to help LLPs to determine whether there is an unavoidable obligation to deliver cash. But like I said, it's not meant to change any of the underlying accounting or fundamental accounting of the swap. Then we are now looking at the updates to IFRS 102. So I've just mentioned a new version being printed, but the RC are now looking to update IFRS 102, and in particular areas they're looking at is whether the big three, as we call them, IFRS 15, 16, and 9, whether aspects of those could or should be incorporated into into the changes to IFRS 102. The FRC is also waiting for the ISSB to finish its work on the IFRS for SMEs standard. But this is something that is happening now. We're expecting an exposure draft, a FRED, but not before September 22. But in the meantime, the FRC is doing its outreach and roundtables particularly on these three items that I mentioned, IFRS 9, 15, and 16. So if you do have a view on these, particularly if you've done perhaps IFRS 15 for your group accounts, but not done it for your IFRS 102 accounts, for your subsidiary accounts, and you have a view as to whether you think it would be a good idea or not, this is the opportunity to get in touch with the FRC and let them have your views. And then this is just a change mainly affecting listed companies. So the temporary reliefs for filing deadlines are being removed from for periods ending on or after 28th of June 2022, which means that we now go back to the normal rules. So for main market companies, annual reports need to be filed 4 months after the period end, and for half yearlies 3 months, and for AIM companies 6 months for the annual reports, and half yearly 3 months. So with that, I'll now hand you over to Anthony, who will talk about IFRS 17 insurance contracts.
Thanks, Moses. Moses talked there about the big three standards. Well, if you're an insurance company, that's sometimes fair in significance compared to IFRS 17, which is changing the entire liability side of the balance sheet pretty much for insurance businesses. But I'm not going to talk through the accounting for insurers, but I do want to just highlight that it can have a wider effect for non-insurance companies as well. So moving on, just to pick up some of the key features. The first thing to note is the scoping of IFRS 17 is not based on the nature of the entity, but based on the nature of the contracts you issue. So it applies to insurance contracts, not to insurance companies. Now, an insurance contract, as defined in the standard, is one where one party, the issuer or the supplier, accepts significant insurance risk from another party, policyholder or customer, by agreeing to compensate them if a specified uncertain future event adversely affects the policyholder. So if a supplier of goods supplies a product and that product subsequently fails, that will be an event that has an adverse effect on that customer. And if the supplier of that product promises to replace or repair that product, then risk has been transferred from the customer to the supplier, and they have effectively issued an insurance contract. So that's what we're kind of looking for, is what other situations will be meeting this definition of an insurance contract. Now, to be honest, the definition of insurance contract hasn't actually changed significantly with the introduction of IFRS 17. It used to be the same, or very much the same, under IFRS 4. But because IFRS 4 was so permissive in its accounting requirements, you could have been issuing insurance contracts, or things that meet the definition, never having really realised it, and set about on accounting policies without any thought of IFRS 4, but your accounting policies would have still been appropriate, because IFRS 4 was so permissive. The issue now is IFRS 17 is far more prescriptive in the accounting that's required. And in fact, that's the whole purpose of IFRS 17, was to bring consistency across entities and across jurisdictions on the way insurance contracts are accounted for. The way it's at today, gaps for different countries around the world are very different in the way insurance contracts are accounted for. And in fact, multinational insurance companies often just have multiple gaps all consolidated in one set of accounts, using different policies for different, depending on where the insurance was issued. That's what it's looking to address. That's why it's more prescriptive. But that's why if a non-insurer is issuing something that meets the definition, they now need to think about what 17 says, because their previous policies may not be appropriate. Now, the accounting that's required by 17 is complex. It involves lots of detailed forecasting. It introduces new concepts such as risk adjustments and the need to apply judgment in measuring those. And to be honest, to go through IFRS 17 would take the whole of this session and many more. So I'm certainly not looking to do that in this session. What I do want to do is just highlight what you need to do to just check that either whether any of the contracts you issue do contain an insurance contract, but importantly, either is it within the scope of 17? Because whilst it defines what insurance contracts are, it does then exclude some of them from the standard. But that's what we're going to do. We're not going to go through the complexity of the standard. We're just going to hopefully try and arm you with the ability to filter your contracts and know if 17 will be relevant. And that's a fairly immediate issue because it is effective for next year with comparative. So even 2022, 17 will be needed. Sorry, now move the slide on. Thank you. Okay, so I mentioned, I said there what the definition of insurance contract is, and it's encapsulated by the first two bullet points on the left. The issuer or the supplier accepts some insurance risk from the policyholder or customer. And what that means is if some uncertain future event occurs that has an adverse effect on the policyholder or customer, then the supplier will provide some kind of compensation. Now, that compensation doesn't necessarily have to be cash. It can be in the provision of services, such as sort of repairs, or if your car breaks down, coming and picking you up and taking you to a garage. So those are still uncertain future events that have an effect on the customer, and you are providing compensation by repairing the car, repairing the machine, or taking the car to a garage. That uncertainty might be down to the probability of the event. It might be uncertain whether it will happen, or it may be uncertain onto how much it would cost to put right. The uncertainty in the standard could cover, in the definition, could be on any of those elements. Importantly, though, to be an insurance contract, it must be transferring more than just a pure financial risk. So, an interest rate swap, for example, that can be seen to compensate the holder for losses arising from movements in interest rates. But because that risk is a purely financial one, it purely is based on movements in market prices, market interest rates, then that's considered to be purely a financial risk and doesn't fall within the definition of a significant insurance risk. So that's what we're looking at, and hopefully you've seen from a few of my comments there that you might have something that meets that definition. But importantly, there are some exclusions, so things which meet the definition, but you still don't need to apply 17. Some of them are simply because they're better dealt with already in other accounting standards. So classic example of that is defined pension schemes. That is effectively an insurance contract, but IS 19 already provides the accounting requirements for that, so it's scoped out of 17. Similarly, financial guarantee contracts in the past, you've been able to consider them to be accounted for under 19 rather than deeming them to be insurance contracts, and that can continue. The area I want to focus a little bit on, though, is product warranties, because some are excluded from IFRS 17, but not all of them, and I'm going to explain which are in the next slide. So, in this scenario, there is a parent, might be a manufacturer, might be a retailer, might be a dealer, but the key point is they supply goods to customers. Underneath that parent, there's a subsidiary company, which is the warranty company, and in some instances, warranties are issued by that on behalf of the parent or in relation to the parent's products. Now, there could be like 3 different types of arrangements I'm going to talk about here. A standard 12-month warranty that's issued by the parent automatically with the product, or extended warranties which are issued by the subsidiary, and they might be issued when the product is sold when they're alongside the product at the same time of the product sale, or some might be sold subsequently in some form of extended warranty that a customer can come and request. Well, what the standard says is product warranties are outside of the scope of 17 if they're provided by a manufacturer, retailer, or dealer in connection with the sale of its products to a customer. So it has to be outside the scope. It has to be issued by the entity selling the product at the time the product is sold. So looking at those 3 potential arrangements, the standard 12-month warranty is issued automatically with the product. It's there when the parent sells the goods. That is within the exclusion. So you don't need to worry about IFRS 17. Instead, you'd apply IFRS 15 and IS 37. And that exclusion will apply in the parent's own books because it's the one selling both items at the same time, issuing the warranty at the same time as selling the goods, and in the group accounts as well. Then onto the extended warranty. Well, this is sold at the time of the sale, and so it is in connection with the sale of the products. But the other part of that criteria is that they're provided by the manufacturer, retailer, or dealer. What that means is the exclusion will apply in the group accounts because the group is a single entity for reporting purposes anyway, and that entity has both delivered the goods and delivered the warranty. So the scope exclusion will apply in the group accounts, but it won't apply in the subsidiary standalone accounts if they apply IFRS 17. That subsidiary does not deliver the goods, so there is no exclusion from 17 within the subsidiary's own account. When you get to the third arrangement, where you issue a warranty at some later date, the customer comes back and says they'd like to extend the warranty for a year, 2 years later. Well, that warranty has not been issued in connection with the sale of the products. So it will fall within 17. It will fall within 17 in the subsidiary, and it will fall within 17 within the group accounts as well. So product warranties, many of them will be exempt because often they're issued at the same time, but you've got to take care on who is issuing them, and was it done at the time of the sale. So moving on to another exclusion from 17 that again would be more relevant to non-financial corporates is for fixed fee contracts. It's a very strange exclusion, this, in that it's optional, and it's optional on a contract by contract basis. Well, what this one says is you can choose to apply IFRS 17 or IFRS 15 on a contract by contract basis for what the standard terms as fixed fee contracts. Examples there in the box: maintenance contracts, roadside assistance, but critically it has to meet the criteria on the screen there. The price that you've charged the customer is not a function of the risk associated with that particular customer. So in other words, you haven't tried to price insurance risk into the specific risk that customer will create for you by you taking on this promise for the future. The nature of your promise must be in the form of services, so hence you will provide the maintenance rather than providing cash compensation for any repairs that are needed. And the insurance risk arises primarily from the customer's use of the services rather than the cost. What that's trying to get at is the key risk is, will there be a breakdown or not, rather than there being a great variability in the cost of correcting for potential breakdowns. So that third one certainly needs the application of some judgment. But what we're looking for here is where you charge a fixed fee for future services should there be an uncertain future event, such as a breakdown. And if these criteria are met, you then have a choice whether to sit within 17 or 15. Moving on. So that's all I really wanted to cover, just these few examples of where there are contracts outside of the financial or insurance industry where 17 might apply. 17 is complex, so I would advise you try and think about it as early as possible, because as I say, if you've got a December year end, you're already in the middle of the comparative period, and next year's accounts 2023 will require you to include these comparatives. But what it needs you to do is think about the promises you make under your contracts. Do any of those promises include the transfer of insurance risk, a promise to mitigate or compensate should some adverse future event arise? And then, okay, if some contracts have those kinds of terms, look to see, do they filter out because of those scope exclusions? Either because it's a product warranty where the warranty is issued by the seller at the time of the sale. Finance related products, if it's purely a financial risk, then it's not going to be within 17. and for those fixed fee contracts, consider whether you meet all the conditions, and if you do, be ready to make your accounting policy choice, 17 or IFRS 15. So that's that on 17, and indeed that's that for financial reporting, at least in terms of accounting standard setting, accounting standards. Now I just want to move on to talk a little bit of an update on sustainability reporting. As I said at the outset, that there's been a lot of things happening over the last weeks and months, and certainly over the last quarter. Expansion of the number of entities governed by the FCA rules around to provide TCFD disclosures. BEARS has finally issued some regulations and guidance we highlighted at a previous webinar, and developments on the international scene as we move towards global standards. Let's start then with the UK and the FCA rules. Last year was the first year for premium listed commercial companies where they were required to provide TCFD disclosures on a comply or explain basis. That required them to make a statement of compliance if they didn't comply with all of the 11 disclosures, to explain why. And so, companies right now are reporting for the first time, those were reporting to December 2021, compiling their TCFD disclosures if they're premium listed. And we've started to see some of these come through, and I'll say a little bit about what we're finding. The FCA highlighted that they would extend that, and now they have done. So they've extended the scope as expected to standard listed companies and those that issue global depository receipts, GDRs, and as we previously expected, they are also now within those same comply or explain TCFD disclosure requirements, but for years commencing 1st of January 2022. So this is their first year for gathering that same information to be able to report on it in early 23. Third extension of the use of TCFD has been down to new legislation that was issued. Again, we knew it was coming, but it is now being finalised and is in place. And so this new legislation requires, I'm just making sure I don't get the scoping wrong. So this is for large entities, like private entities and AIM companies with 500 employees, large public interest entities, and large private companies with a turnover of more than 500 million and more than 500 employees. Now, the legislation is aligned with TCFD, but it doesn't use exactly the same word, and that's best because it is extending the previous requirements for a non-financial information statement and turning that into a non-financial and sustainability information statement, and using the terminology that was used in the past. So, for example, instead of talking about metrics, it'll talk about KPIs. And the risk disclosures are within the principal risks disclosure requirements previously set. But it is aligned, and I'll come back and say a little bit more about it in a moment. But that's not it. We still expect more to come in the future. And we do expect that the UK government has announced that when the ISSB standards are issued, and I'll talk a little bit about the exposure drafts for those, once they're in place, they will form part of an extended sustainability disclosure requirements that will, be implemented over the next couple of years. Beyond that as well, there's also TCFD aligned disclosures for asset owners, asset managers, pension schemes, but those disclosures won't be in the annual report. It's more aligned to the products that they issue and need to be disclosed in other ways. Right, so what we've seen so far with these premium listed companies that have been doing it for the first time for December 21 year ends, and they're now starting to report, be it our clients or others that we have seen out in the market. I mean, it's certainly true that there is a broad range of readiness for the TCFD disclosures. Some more ready than others, particularly around the more granular detail or metrics, more detail around the resilience to various scenarios. So the scenario planning, you know, those areas in particular certainly need more work. But to an extent, that's expected. The FCA do expect people to be able to set out what their strategy is. They should expect people to set out what their risk assessment process is at the moment. Sure, they might improve in time, but you should at least be able to provide the disclosures of what you're doing today. But the FCA realise that metrics will take time to develop, scenario testing will take time to develop. But the important thing is the best reporters, even if they're not fully there, are transparent about their progress and what they plan to do and how they will achieve the full disclosures over time. One thing that we have seen is sometimes missed is the listing rule requires an explicit statement of compliance with the TCFD and a statement of any explanation of any omitted disclosures with explanation as to why. And we have seen, have been picked up a few times, a failure to provide that explicit statement of compliance and proper explanation of emissions. So that's one area to really think about. If you are reporting, or as the scope extends over the future, be ready to report. Excuse me. We have saw a growing use of consultants being employed to help with this reporting, but importantly, the management and the board must provide input into it. They're the ones who are meant to be overseeing not only the reporting, but also the risk management and the strategy setting and the incorporation of TCFD into the thinking. So they must be active participants in the reporting. And it does take time. And so do start early and get the board on board and providing their input into the thinking and the reporting. Final point there, now if you're discussing things in the front end related to TCFD, or indeed any element of sustainability reporting, let's be frank, it's more than just TCFD, then make sure that the assumptions, the scenarios that you've been considering for the front end also are consistent with the scenarios used in the back end, assumptions, judgments that might be affecting the measurement. The regulators are looking very carefully for that consistency. I mentioned about the BES regulations that are now there to extend the scope beyond those subject to the listing rules. Two pieces of legislation, one for companies and one for LLPs. Purpose of this is to, the way this works will be to extend for companies the contents of the strategic report. There will be now the requirement to include a non-financial and sustainability information statement in that strategic report, or if you're an LLP within your energy and carbon report. The disclosures are based on the TCFD's 4 pillars and based on the 11 key disclosures of TCFD. I know we're not looking at those in detail today, but we have looked at them in previous webinars. But they do match, they are aligned, but some of the wording is different to try and because it's necessary to fit in with the existing legislative requirements. To help you navigate that, should you be both subject to the FCA listing rules and subject to these legislative requirements, BES have issued some Q&A guidance, which talks through that overlap, help you navigate the two together, and also builds on or provides guidance around what you do in group situations, and materiality assessments for the purpose of this legislation, and how the statement of resilience to climate risk can be based on qualitative scenario analysis. I said that the government has already highlighted that they will expand the disclosures to start including the disclosure requirements to include what comes out of the ISSB. Well, they've issued their first exposure drafts now. Now the ISSB, the International Sustainability Standards Board, sits alongside the IASB within the IFRS Foundation. And what this second board will issue are IFRS sustainability standards. And so we have here exposure drafts for the first two, IFRS S1 and IFRS S2. And the aim of these is to provide a kind of comprehensive global baseline for sustainability disclosures, to try and lead towards consistent, comparable information as investors have been calling for. And it will give everyone a single benchmark, both in terms of the supply of information by companies, but also the information that investors are demanding. Because at the moment, those more demanding of investors, if you've got multiple investment houses, they may currently be asking for different information. And the hope is this will create a more seamless supply of information. The first of these, S1, this is around general requirements for sustainability related financial information. So it goes beyond, it isn't just about climate change. What it's doing is it's setting out definitions and general requirements for sustainability disclosures in general. Importantly, one thing it's proposing is that all material sustainability related risks and opportunities should be disclosed, irrespective of whether there is an IFRS S, whether there is a sustainability standard in place or not. So effectively, if that is adopted and mandated, what it's then saying is, okay, follow IFRS S2 for the climate disclosures, but you've also got to provide sustainability disclosure on sustainability risks and opportunities more broadly. And then it says, well, if in the absence of one of their standards, you should look to other sources, and that might be things like those issued by SASB, the Sustainability Accounting Standards Board, or elsewhere. So if that first one is adopted, it immediately broadens the scope of these standards before those standards have actually been written. And in the meantime, you'll have to look to other sources for metrics. What does the second one cover? Well, that's on climate-related disclosures. It very much incorporates the TCFD recommendations, but it also sets out lots of metrics, both general and industry-specific metrics, which they've taken from previous standards, those issued by the SASB. So really drilling down into some granular detail on what would be appropriate metrics to disclose. All of them focusing on this. Just one thing I want to finish with is on this slide is everything that the ISSB is looking for is to provide information that is relevant and to assessments of enterprise value. So ultimately, we're looking at these sustainability issues through the lens of, and will they in the long term affect the value of the business, the enterprise value? I say that because of something I'll come back to on the next slide. Because in Europe, at the same time as the ISSB is issuing its exposure draft for commentary by July and hopefully standards by the end of the year or early next year, well, the EU is as a project to develop its own standards. So the EU have their corporate sustainability reporting directive, and this is to be effective by 2024. And it's an expansion of the previous NFR directive. And importantly, it applies not only to EU listed companies or to EU groups, but to the EU subsidiaries of non-EU groups. So if you've got any European subsidiaries, they may well be required to comply with these standards when they're issued. The scoping is for large companies, but large in the European definition is much smaller than that I've just been talking about for the UK expansion. For the size criteria for applying these new standards will be total assets of 20 million euros, revenue of 40 million euros, 250 employees. So if you've got European subsidiaries of that scale, well, then this will be relevant to them. Now, this directive is going to be supported by a whole suite of new sustainability standards that have been developed by under development by EFRAG. A consultation will begin soon on 28 standards that cover both the kind of generality around kind of governance, business model type of disclosures, but drill down into increasing detail through climate change, diversity, cyber risk, or very detailed standards on all of these areas. Now, these are going to be consultations will begin on some of these this year, and then they will be applicable starting in 2024, and with some assurance requirements as well. If you've got subsidiaries that are below that threshold I mentioned, just be aware that there's an expectation that once these are issued, there will be variants of these requirements for smaller entities in Europe as well. It's not just in Europe though. In the US, the SEC are consulting on climate-related disclosures in US filings, such as 20Fs. Again, based on TCFD, so at least there we are seeing some alignment with what's happened at the ISSB. And the plan is, again, climate-related disclosures to be phased in from 2024. I won't go through any more detail about that. One for you to look out for if you've got any US connections. Finally, then, quite a quick tour through all of the detail, but you can find further detail on some BDO publications we have issued, available via our website on the BDO global website. This will become a regular event with quarterly bulletins, updating on recent developments in sustainability reporting, given the level of activity. And you can also access, if you wish, online training module explaining TCFD in practice with examples. That's it for this update. If there are any questions, I don't think any have come through. No, we haven't received any. But if you do have any, please drop them on the chat or contact us. But what we will do is, nothing's coming, no questions being raised. So just a reminder what Moses said to begin with. We will send out to you copies of the slides and a link to where you can watch again a recording of this, and indeed share that recording with colleagues. But as there's no more comments or questions, I wish you a very good afternoon, and thank you for your attention. Goodbye for now.